Hey there, savvy investors, and welcome back to the channel where we demystify complex market concepts. Today, we're diving deep into a fascinating micro-cap stock that recently popped up on our hard-to-borrow screener, NCT, or NCT Cayman Limited. We're going to break down what makes this stock intriguing for those interested in short squeeze dynamics, explain the critical metrics like cost to borrow, and discuss what to watch for. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zoom in on NCT, officially known as NCT Cayman Limited. Your company logo / stock chart. This company operates in the industrial / marine shipping sector, providing maritime shipping services, time charter, and vessel management internationally with a footprint in Hong Kong. Interestingly, they are also involved in the processing of pulp, paper, and paperboard products. It's a micro-cap company, meaning its market capitalization is relatively small, which can often lead to more volatile price movements. Looking at recent price action, NCT has had an interesting run. Today, it's seen a slight dip of 0.83%. However, over the last 5 days, the stock is up a modest plus 1.42%, and in the last 30 days, NCT has climbed an impressive plus 13.69%. Highlight 30-day gain on chart. Volume-wise, today saw 885,600 shares traded, which is right around its 30-day average volume of 849,396 shares, giving us a relative volume of 1.0x. So, no massive volume spike just yet, but the price momentum over the past month is noteworthy. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important when we talk about potential short squeezes? Simply put, if you want to short sell a stock, you first need to borrow shares from someone who owns them, usually through a broker. This isn't free. You pay a fee to borrow those shares, and that fee is the cost to borrow. It's expressed as an annualized percentage. When a stock is hard to borrow, it means there's high demand from short sellers and / or a limited supply of shares available to lend. This scarcity drives the cost to borrow fee sky high. Think of it like a rental car. If everyone wants a specific car and there are only a few available, the rental price goes up dramatically. A high CTB indicates that short sellers are paying a significant amount just to keep their short positions open, and this can be a major factor in their willingness to hold on to those positions. Why this stock is hard to borrow right now. Now, let's talk about why NCT specifically landed on our hard-to-borrow radar. The current annualized cost to borrow fee for NCT is a staggering 677.5%. Emphasize 677.5%. To put that into perspective, if you borrowed shares of NCT for a full year, you'd owe a fee equivalent to almost 7 times the value of those shares. This is an incredibly high number and signals extreme demand to short the stock relative to the available supply. We're also looking at an estimated float of just 0.3 million shares. Highlight 0.3 M shares. A small float means there are fewer shares available for trading in the open market, and even fewer available to borrow, which can further amplify the cost to borrow. The exact number of shares currently available to borrow for NCT is unknown, but a CTB this high strongly suggests scarcity. Our internal composite squeeze score for NCT sits at 42.5 out of 100, indicating it's certainly on the radar, though not at the extreme end of potential squeeze candidates yet. Squeeze mechanics explained. So, with a high cost to borrow like NCT 677.5%, the stage can be set for a short squeeze. Imagine this: short sellers are betting the stock price will go down. But if the stock starts to climb, as NCT has done over the past 30 days, those short positions begin to lose money. Add to that the exorbitant 677.5% daily fee they're paying to keep their positions open, and the pressure intensifies. If the price continues to rise, and the supply of borrowable shares dwindles further, some short sellers may be forced to cover their positions. Covering means they have to buy back the shares they initially sold short in the open market. This sudden demand for shares, fueled by short sellers covering, drives the price up even more, creating a cascade effect where more short sellers are forced to cover, thus squeezing the price higher. It's a supply and demand dynamic, where decreasing supply of shares meets increasing demand from short covering. Dilution risk check. Before getting too excited about squeeze potential, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can depress the stock price. This is a significant factor because even if a stock has a super high cost to borrow, new share issuance can flood the market with supply, effectively negating any potential short squeeze. For NCT, our check found no recent diluted SEC filings like SMINUS1, SMINUS3, or 424B in the last 90 days, which is a positive sign. Furthermore, we found no recent reverse split for NCT in our look-back window. This means that at this moment, there isn't an obvious, immediate dilution overhang that could counteract a short squeeze thesis for NCT Cayman Limited. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given NCT Extreme 677.5% cost to borrow and its tight 0.3 million estimated float, what should you be watching for? First, keep an eye on the cost to borrow itself. Any further significant increases would signal even more pressure on short sellers. Second, monitor the availability of shares to borrow. If that number drops to zero, it means short sellers cannot easily open new short positions or add to existing ones, and those already short face increasing difficulty. Third, volume is key. While NCT volume today is around average, a sudden surge in buying volume, especially on green days, could be the catalyst that triggers significant short covering. And finally, watch the price action. While a high CTB does not guarantee a squeeze, it can also indicate strong conviction from short sellers who are willing to pay high fees because they believe the stock will ultimately drop. Continued upward momentum, particularly if it breaks key resistance levels, would be a strong indicator of building pressure. NCT plus 13.69% over the last 30 days is already a good start. NCT Cayman Limited, or NCT, presents a very interesting case study with its astonishing 677.5% cost to borrow and tiny 0.3 million share float. While a high CTB is just one piece of the puzzle, it's a significant indicator of the potential for a volatile move, especially when coupled with the absence of immediate dilution risk. Remember, the market is complex, and thorough due diligence is always paramount. Stay informed, stay educated, and keep learning. If you found this breakdown of NCT insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments if there are any other hard to borrow stocks you'd like us to investigate next.